Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. So this morning we had the June PCE report come out for inflation. Nothing from the report dissuade the notion that the Fed's going to cut rates in September. In fact, we had the lowest 3-month annualized rate this year for inflation, so good news on that front. If you look at the Fed fund futures probabilities, there's a 100% probability that the Fed will make at least a 25 basis point cut at that meeting on the 18th. And we've seen interest rates react to those expectations of the Fed's accommodative policy. The yield curve inversion, which has been in place for a record length of time, short maturity bond interest rates are moving much lower than the long end of the curve. So that yield curve inversion is close to ending. Now, the PCE, this is the Fed's preferred measure, is on the chart here. You can see both the headline and the core PCE, the blue and the orange respectively. It came in at 2.6 and 2.5% respectively for those two different measures. Just a reminder, the core is essentially the headline subtracting energy and food, which are the more volatile parts of the inflation index. And you can see that's a little smoother because of that. Both of those are below the 5-year average of 3.5%. The Fed's long-term target for this measure of inflation is 2%. So we're not at 2%, but you can see that it's coming down lower. A couple positive notes from the June report. The month-over-month gain in the month of June for inflation index was 0.2% on its own, not very, very low. But if you take a look at the past 3 months and annualize it, the annualized 3-month PCE rate is 1.7%. And that's the lowest that we've seen all year, and reminds me a little bit of that inflation that we saw back in the fourth quarter when everybody was expecting the Fed to cut rates because inflation had dropped so low. So all is looking good on the inflation front right now. Now, take a look at Fed expectations. Remember, 5.25 to 5.5% is the target Fed funds rate by the Fed right now. You can see a 69.5% probability based on Fed funds futures transactions where participants can speculate on where they think the Fed funds rate is going to be. 69.5% probability that that rate will be 25 basis points lower down to that upper range of 5.25%. But about a 30% probability that they're going to go all the way to a 50 basis point cut. If you listen to Powell over the past week at his press conference, he talked about, quote unquote, the time has come. They're forecasting, they're being very transparent, right? They believe that's a tool for the Fed, that transparency. So the Fed rate cuts coming. I think we're going to get the monthly jobs report. That will ultimately be a big determinant of whether they go 25 or 50. Do we start to see continued cooling in the labor market? That's going to pressure them to be a little more aggressive. Or do we start to see a rebound in jobs of some sort? We also get that CPI right around that Fed meeting as well. So some key potential data points that might impact that decision, but 25 basis points is all but baked in for the market right now. Now take a look at by year end. So we have September, we have November, and we have December. So we have 3 meetings left, 2 meetings before the election, and then that December 18th meeting. But if we fast forward to the end of the year, you can see in that blue box there, all the probabilities of the Fed funds being as low as 4 all the way to 4.5. And you sum all that together and you get 68%. And that 68% represents the probability that the Fed will move the Fed funds rate at least 100 basis points lower by the end of the year. What that means is the market is expecting the Fed to make at least 150 basis point cut, potentially 2 by the end of the year. I think the labor market data is going to be the key determinant of whether that's slow 25, 25, 25, or whether we get a couple 50 basis point cuts during the last part of the year here. Now, take a look at what this means for the yield curve inversion. You can see all the way back in 2022 when the yield curve inverted. This is the 2-year yield minus the 10-year yield on the interest rates of U.S. Treasury government bonds. When this is inverted, it means that shorter maturity bonds have higher interest rates than longer maturity bonds for the US government. That's not normal. Typically, you get lower interest rates when you borrow for a shorter period of time. That happens when people think expectations for interest rates in the future are going to be lower because they predict some sort of an economic slowdown. Historically, it's been a bit of an indicator for recession. It's not been perfect, but you can see that it has been inverted for a very long time because how high inflation was and the fact that many people were expecting there to be an economic slowdown and potentially recession. But with the Fed in expected to cut rates aggressively during the next 6 months, you're starting to see the short end of the curve drop significantly. And the long end of the curve, while dropping not as fast, that yield curve is steepening. This is to be expected. And we're very close, only 3 basis points from uninverting for the first time since 2022. You can take a look at the two different parts of that line that we just looked at, the 2-year yield and the 10-year treasury yield, 10-year in the teal, 2-year in the blue. You can see they're neck and neck, only 3 basis points difference right now. And if that 10-year moves above the 2-year, that inversion, that record long inversion, will be officially over for the market without that recession that so many people have been concerned about. So before we wrap up, August 30th, Warren Buffett, all I want for my birthday is $1 trillion. Congratulations. Happy birthday to Warren Buffett. And at 94 years old, his company, Berkshire Hathaway, surpassed the $1 trillion threshold for total valuation. You can see this is the first non-technology company to do so. So congratulations to Warren Buffett. Still looking great at 94 years old. Maybe the key is to have a $1 trillion company for longevity. Either way, congratulations to Warren Buffett, an absolute legend on your birthday, $1 trillion mark. Pretty good week for Mr. Buffett. So congratulations. With that, I want to thank everyone for watching, and I'll see you next time.